It's happening again. Bitcoin is breaking records, and this time, Wall Street is watching. But is it too late to buy in? Or is this just the beginning of something much bigger? Let's find out. Not long ago, Bitcoin was still dismissed as a gamble, a digital token, a fringe experiment. Too volatile, too risky, too strange to take seriously. But now, it's breaking all-time highs. In 2025, Bitcoin soared past $123,000, up over 90% in less than a year. That's not a typo, 90%. And this isn't some speculative frenzy driven by Reddit traders or crypto influencers. This time, the money is coming from places like BlackRock, Fidelity, and major pension funds. For years, Bitcoin was laughed off. Now it's sitting at the same table as gold and government bonds. So what changed? Why is this digital asset mocked a decade ago now being called the monetary revolution of a generation? The answer starts with a single event. In January 2024, the US approved Bitcoin Spot ETFs. And in that moment, everything shifted. For the first time ever, institutional investors had a regulated, secure, and legally clean way to buy Bitcoin inside their existing portfolios. Before that, most big players, pension funds, insurance companies, public corporations, were locked out. The legal and operational risks were too high. But now, buying Bitcoin is as easy as buying Apple stock, and the numbers prove it. In less than a year, 12 US-based Bitcoin ETFs have collectively acquired over 1.26 million Bitcoin. That's roughly 6% of all Bitcoin that will ever exist, already in institutional hands. And one ETF, BlackRock's IBIT, holds more than 700,000 Bitcoin alone. That's worth over $75 billion. And here's the kicker. It took them less than 350 days. For comparison, the world's biggest gold ETF took 15 years to reach that size. What we're seeing is not just price movement. It's a tidal shift in legitimacy, demand, and infrastructure. Bitcoin is no longer the outsider. It's becoming the new reserve asset. Institutional investors don't chase hype. They follow structure, regulation, and long-term opportunity. And once Bitcoin entered that world, the demand exploded. BlackRock, Fidelity, and other giants didn't just open the door, they sprinted through it. In fact, Bitcoin ETFs have already outperformed expectations in every metric: volume, inflow, and profitability. Let's take BlackRock's IBIT as an example. It charges a management fee of just 0.25% per year. Sounds small, right? But in less than a year, that ETF alone generated $187 million in fees for BlackRock. That's more than what their massive S&P 500 fund earned, even though it's older and larger. Why does that matter? Because it proves the demand is real. Bitcoin isn't just being tolerated, it's being embraced because it works. And institutions aren't just investing casually. They're accumulating at a pace faster than new coins are being created. A report by Galaxy Research revealed something surprising. Bitcoin ETFs and MicroStrategy, combined, are now buying more Bitcoin per month than miners are producing. Let that sink in. New supply is being absorbed faster than it's created, and here's why that matters. Every 10 minutes, a new block is mined, and the reward is fixed. But that reward is cut in half roughly every 4 years, an event called the halving. In 2024, that mining reward dropped to just 3.125 Bitcoin per block. That means only about 450 new Bitcoins are created every single day. Now, compare that to institutional demand, which often buys thousands per day. The result is simple economics. Rising demand combined with falling supply creates massive pressure on price. But this time, it's not driven by retail hype. It's driven by billion-dollar institutions with long-term strategies. And many of them are not planning to sell anytime soon. Some mining companies now hold their Bitcoin instead of selling, waiting for higher prices. This reduces available supply even further. What we're witnessing is the transformation of Bitcoin's role, from digital experiment to institutional-grade asset, to a strategic store of value. It's no longer a question of what is Bitcoin. Now the question is, how much should we hold? And that conversation is happening inside boardrooms across Wall Street. Every asset has its rules. Stocks can issue new shares, governments can print more currency, real estate can be built, expanded, and multiplied. But Bitcoin plays a different game. Its supply is hard-coded. There will never be more than 21 million Bitcoins ever. This limit isn't a guideline. It's baked into the system itself, and that changes everything. While demand can rise infinitely, supply is permanently fixed. That's why every 4 years, something called the halving takes place. It's a built-in mechanism that cuts the reward miners receive for validating transactions in half. No votes, no decisions, no committees, just math. In 2012, the reward was 50 Bitcoins per block. Then it dropped to 25, then to 12.5, then 6.25. And now, in 2024, we're down to just 3.125 Bitcoins per block. With one block mined every 10 minutes, that means only around 450 new Bitcoins enter circulation each day. Compare that to 2010, when over 7,200 Bitcoins were created daily. That's a 94% reduction in daily supply. And yet, demand isn't shrinking. It's rising, fast. Institutions are buying thousands per day, and that's just what we can track publicly. Retail investors, companies, even some governments are entering silently, buying, holding, and waiting. And here's where it gets interesting. Some miners, the ones who produce new Bitcoins, are no longer selling. Instead, they're holding their rewards, betting on higher prices in the future. This behavior tightens the market even more. Imagine if gold miners decided to stop selling gold. That's what's happening with Bitcoin, on a global scale. What this creates is a kind of digital scarcity we've never seen before. A system where the supply shrinks while demand accelerates, and that pressure builds quietly until it bursts. The last 3 halvings were followed by massive bull runs. Now we're in the early stages of the 4th. But unlike the past, this time it's not driven by hype. It's driven by strategy, adoption, and infrastructure. Bitcoin is no longer trying to prove it's real. Now it's being treated as real money by the most powerful financial players on Earth. And in a world where governments can print endlessly, an asset that refuses to inflate becomes extremely attractive. Bitcoin doesn't offer yield, it doesn't generate cash flow, but it offers something rarer: trust in math. And that's something more and more investors are beginning to understand. In traditional finance, interest rates are the heartbeat of the system. When rates rise, money tightens. Loans become expensive. Risky assets lose their shine. Investors flock to safe havens like government bonds. But when rates fall, everything changes. Suddenly, capital flows faster, borrowing becomes cheaper, and the hunt for yield begins again. That's exactly what's happening right now. In early 2025, the U.S. economy began showing signs of fatigue. Private job growth slowed to its weakest pace in years, consumer spending softened, and inflation cooled. All of this puts pressure on the Federal Reserve, not to raise rates, but to cut them. And that's exactly what markets are now expecting. Traders are pricing in at least one rate cut in the next Fed meeting, and potentially more by year's end. Why does that matter for Bitcoin? Because Bitcoin doesn't pay interest. It doesn't send dividends or yield. When rates are high, like 5%, holding Bitcoin comes with an opportunity cost. Why risk your money in crypto when you can earn solid returns just by sitting in treasury bonds? But when rates fall, that cost drops, and suddenly, assets like Bitcoin become far more attractive. Think of it like this. When water levels drop in the bond market, capital starts looking for new places to swim. And Bitcoin, with its global access, limited supply, and rising legitimacy, starts to look like a very appealing ocean. This is exactly the environment that historically precedes Bitcoin's strongest rallies. Liquidity rising, risk appetite returning, institutional confidence growing. And there's another layer. Every dollar printed by central banks devalues existing fiat currency, even subtly. That's not speculation. That's monetary math. As dollars lose strength, real assets gain ground. That's why gold thrives in low-rate environments, and it's why Bitcoin, often called digital gold, begins to shine as well. But Bitcoin has something gold doesn't: portability, programmability, and a growing ecosystem of financial tools built around it. Bitcoin doesn't need vaults. It needs only a private key and a few lines of code. As traditional finance loosens and rates fall, investors aren't just moving toward risk, they're moving toward resilience. And Bitcoin, whether Wall Street likes it or not, is proving itself to be one of the most resilient assets on Earth. For years, Bitcoin lived in a legal gray zone. Governments didn't quite ban it, but they didn't exactly embrace it either. It was seen as a threat, a wild experiment that challenged the authority of central banks, a tool for speculators, hackers, and idealists. But in 2025, something changed. Not in secret, not behind closed doors, but right in the halls of Congress. In what many now call Crypto Week, U.S. lawmakers advanced major regulatory frameworks designed specifically for digital assets. One of them established clear rules for the issuance and supervision of stablecoins, digital currencies pegged to the U.S. dollar. Another bill aimed to clarify the roles of the SEC and the CFTC, defining exactly who regulates what when it comes to Bitcoin, Ethereum, and the broader crypto space. What does this mean? It means Bitcoin is no longer treated as a glitch in the system. It's being recognized as part of the system. For the first time, the U.S. government isn't fighting the crypto revolution, it's trying to guide it. That's a signal, because regulation, while often viewed as restrictive, is actually a green light for large institutions. They don't move in uncertainty, they wait for rules, and those rules are finally being written. This is why banks are launching Bitcoin custody services. It's why brokerages are offering crypto alongside stocks. And it's why ETFs are no longer just a dream, they're reality. In the past, Bitcoin was shadowed by fear, confusion, and legal risk. Today, it's becoming infrastructure. This shift opens the door to innovation, adoption, and even more capital. And here's the bigger picture. Bitcoin isn't just a coin. It's the tip of a much larger iceberg. Behind it is an entire ecosystem of decentralized finance, global payments, yield-generating crypto dollars, and new forms of ownership and income, all without intermediaries. Regulation doesn't kill that, it unlocks it, because with clear rules comes confidence, and with confidence comes participation at a global scale. We're not talking about a niche anymore. We're talking about a new layer of the financial system. And those who understand that now may find themselves positioned far ahead of those who wait. Let's address the question everyone's asking. Is it too late to buy Bitcoin? After all, the price just hit an all-time high, and more than 99% of wallets are now in profit, which means, statistically, almost everyone who bought before is now sitting on gains. That alone creates pressure, because when people are deep in profit, they're tempted to sell, to lock in gains, to wait for a dip, and yes, that can trigger short-term pullbacks. We've seen it before. But here's the twist. Despite record prices, despite massive gains, the mood in the market isn't euphoric, not yet. According to the Fear and Greed Index, sentiment is high, but it hasn't hit extreme greed levels, the kind that often signal a final peak. Instead, what we're seeing is optimism with caution. Excitement, yes, but not mania, and that matters. Because in past cycles, true tops came with blind euphoria. People mortgaging homes to buy Bitcoin. Media outlets running headlines like, "Crypto will replace the dollar." We're not there. In fact, some data suggests we're still early in the current cycle. Let's look at another tool, the Mayer multiple. It compares Bitcoin's current price to its 200-day moving average. Historically, when this multiple rises above 2.4, the market is overheating, and pullbacks are likely. Right now, that multiple is sitting around 1.21, below its long-term average of 1.3. In simple terms, Bitcoin has rallied, but it's not overextended, at least not yet. This suggests there's room to run, but that doesn't mean you should FOMO in blindly. Short-term corrections are always possible. Volatility is part of the game. The real question isn't, should I buy at $123,000 or wait for $110,000? The real question is, will I be exposed when the world fully wakes up to Bitcoin's value? Because over the long run, it might not matter whether you entered at 120 or 100,000. What will matter is being in and staying in when the next wave arrives. And that leads us to the mindset that separates long-term builders from short-term traders. Most people obsess over entry points. Should I buy now? Should I wait for a correction? What if it crashes? But the people who build real wealth in assets like Bitcoin ask a different question. What am I building? And what role does Bitcoin play in that? Because if you believe Bitcoin has a future, as a store of value, as digital gold, as a hedge against inflation and fiat devaluation, then the most important thing isn't the perfect entry. It's being in the game and staying in. Let's flip the script. Imagine this. You wake up tomorrow and your entire net worth is in cash. You have a clean slate. How would you rebuild your portfolio? If the answer includes holding some Bitcoin, then by not selling today, you're already choosing to hold it again tomorrow. That's the mindset of conviction. Not based on hype, not based on price targets, but on belief in the long-term thesis. And if you're just getting started and have little or no exposure, the strategy doesn't have to be complicated. It can be as simple as buying small amounts regularly, weekly, bi-weekly, monthly. Some call it dollar cost averaging. We call it building a base, because timing the market is nearly impossible. But staying consistent, that's in your control. One of the simplest strategies we've seen work is this. Pick a day. Stick to it. Ignore the noise. Whether Bitcoin is up or down that day doesn't matter. What matters is that you're stacking quietly, consistently, strategically. And here's something most people forget. We are still very early. Less than 3% of the world actively holds Bitcoin, and it represents under 0.2% of global wealth. The big money is only beginning to move. Most central banks haven't entered. Most governments are just starting to understand what Bitcoin even is. This isn't the end of a cycle. It might be the beginning of a transformation. And when history looks back, today's price, even at over $120,000, may look like a rounding error. Because the real value of Bitcoin isn't in the charts, it's in the shift. A shift in who controls money. A shift in how we define trust. A shift in what it means to own something absolutely, without needing permission. And that brings us to the final part of this journey. Not just what Bitcoin is worth today, but what it could represent tomorrow. So why does Bitcoin keep rising? Because something deeper is unfolding. This isn't just about price, it's about perspective. Bitcoin is forcing people, institutions, governments, everyday savers, to ask a question they never had to ask before. What makes money? Money. Is it the backing of a government? A promise from a central bank? Or is it something more powerful? Something digital, decentralized, and mathematically enforced? For years, the system rewarded those who understood fiat. Today, it's beginning to reward those who understand scarcity. Bitcoin doesn't need marketing. It has gravity. The more people look into it, the harder it is to walk away unchanged. And if you've ever felt behind, if you've watched others build wealth and wondered, did I miss my chance? Remember this. We are not at the top of adoption. We are at the edge. You don't need to time the bottom. You don't need to buy it all. You just need to start small, coax, and think long. Because the real opportunity isn't in buying a perfect dip. It's in being positioned when the rest of the world wakes up. The truth is, most people will never take action. They'll overthink. They'll wait for certainty. And by the time the path is clear, the train will be gone. But you're different. You're here, now, looking deeper. And maybe that's all it takes to shift everything. Because every small purchase you make, every habit you build, every time you choose strategy over fear, you're not just investing in Bitcoin. You're investing in sovereignty. You're building a system that works even when the world doesn't, and that's the real revolution. If this video helped you see Bitcoin with new eyes, give it a like, subscribe for more stories that reveal how money really works, and drop a comment below. Are you already exposed to Bitcoin, or are you still waiting for the perfect time to start? Let's build a conversation of clarity, not hype, and remember, every dollar you protect today is one you won't have to chase tomorrow.